Picture this. You're at a bustling market and you see the freshest, juiciest apples you've ever laid eyes on. You want them, but you don't have the cash on hand. So, you make a deal with the vendor to buy them later at the same price. Well folks, you've just entered the world of options trading. Welcome to the world of trading, a realm filled with complexities, opportunities, and yes, a fair share of jargon. But don't worry, we're here to break it all down for you. Think of the market as a giant global supermarket, but instead of buying and selling groceries, we're dealing with stocks, bonds, commodities, currencies, and a whole lot more. Now let's talk about options trading. Remember the Apple market scenario? That's essentially what an option is. It's an agreement or a contract that gives you the right to buy or sell an asset at a certain price within a specific time period. It's a bit like reserving those juicy apples for later, but in this case the apples are shares of a company and the market is the stock exchange. But why would anyone want to do this, you ask? Well, options can be used in various ways. They can help protect or hedge a stock portfolio against a drop in price. They can generate income when the market is flat, and they can even allow a trader to speculate on the direction of stock prices with a lot less capital at risk than buying stocks outright. However, it's important to note that while options trading can be profitable, it's not without its risks. Just as you could lose your deposit if you don't pick up those apples, you can lose your investment if the stock price doesn't go the way you predicted. So it's crucial to have a solid understanding of how options work before you dive in. And that's what we're here for. We'll guide you through the maze of trading, helping you understand the difference between a call and a put, explaining how you can sell or buy options, and much more. Just like in our Apple market scenario, options trading is all about securing a deal for the future. But instead of apples, we're dealing with stocks. Intrigued? Let's dive deeper. So, you've got your eye on those juicy apples, or in our case, a promising stock. You're pretty sure the price is going to go up and you want a piece of the action. This, my friends, is where call options come into play. Imagine you're standing in an apple market. You see a vendor with the most delicious-looking apples you've ever seen. But you don't have enough cash on you right now, so you make a deal with the vendor. You pay a small fee up front, and the vendor agrees to hold a bag of apples for you at today's price. Let's say $5 a bag, for the next week. Now let's say during that week, a sudden apple shortage hits the town. The price of apples skyrockets to $10 a bag. But remember that deal you made with the vendor? You can still buy your apples for $5 a bag. You could even sell them right away for $10 a bag, making a tidy profit. In the world of trading, this is the essence of a call option. Instead of apples, we're talking about stocks. You're not buying the stock outright. Instead, you're buying the right, but not the obligation, to buy a certain amount of shares at a predetermined price, within a specified time frame. The fee you pay up front is called the premium, and the price you agree to buy the shares at is called the strike price. If the stock price goes up above your strike price within your time frame, you can exercise your option and buy the shares at the lower price, potentially making a profit. But remember, the stock market isn't as predictable as an Apple market. If the stock price doesn't rise as you expected, you could lose the premium you paid for the option. So, while the potential for profit is high, so is the risk. Just like securing those apples for a future payment, with call options, you're betting on a stock's price going up. But what if you believe the price will go down? Enter put options. Now imagine you've already bought those apples, but you have this nagging feeling that they might not stay fresh for long. So to protect yourself, you arrange to sell them to someone else at a fixed price. This is the essence of a put option. Picture this. You're the proud owner of a bushel of apples. You've got them at a great price and you're pretty happy about it. But then, you start to worry. What if these apples don't stay fresh? What if the price drops and you can't sell them for what you paid? Enter the put option. In the world of trading, a put option is your safety net. It's a contract that gives you the right, but not the obligation, to sell a certain amount of stock at a predetermined price within a specific time frame. So, in our Apple analogy, you're arranging to sell your apples to someone else at a fixed price, regardless of how the market fluctuates. Now let's delve a little deeper. The key word here is option. You have the choice to sell your stock, or in our case, apples. If the price of apples drops and you can't get your original investment back, you can exercise your put option and sell at the agreed price. But if the market price remains the same or even goes up, you can simply let your option expire and sell your apples in the market. So, you might be wondering, where's the profit? Well, the beauty of put options lies in their potential for profit when the stock price goes down. If the price of apples plummets, you can still sell your apples for the original price thanks to your put option. The difference between the market price and your selling price is your profit. In essence, put options are like an insurance policy. They protect you from potential losses and offer a chance to profit when the market doesn't go your way. But remember, with put options, you're essentially betting against the stock. It's like an insurance policy for your apples, or, in our case, your investment. We've talked about buying call and put options, but who's selling these options? Well, that's the other side of the playground. Picture this, you're at an amusement park, and you've got 2 rides to choose from. The Ferris wheel, that's like buying options. It's a bit safer, you know what you're getting into, and the view from the top can be pretty spectacular if you time it right. But then there's the roller coaster, that's like selling options, it's riskier, sure. The drops can be stomach-churning and the climbs can be nerve-wracking, but the thrill? It's unbeatable. When you sell an option, whether it's a call or a put, you're essentially taking on an obligation. You're saying, I'll be here, ready and waiting if the buyer of this option decides they want to exercise it. You're the one who has to deliver if that buyer calls your bluff. Now, why would anyone strap themselves into that roller coaster? Why take on that risk? 2 words, option premiums. When you sell an option, you pocket the premium right away, no matter what happens next. It's like getting paid to ride the roller coaster. But remember, with great rewards come great risks. If the market doesn't go your way, you could end up losing more than that premium you pocketed. It's a balancing act, a game of risk versus reward. Think about it like this, selling a call option is like saying, I bet the price of this stock won't go above a certain point. And selling a put option? That's like betting the price won't fall below a certain point. So, who's the winner in this playground? Well, that's the million-dollar question, isn't it? It all depends on the market, your strategy, and a little bit of luck. Selling options is like being the apple vendor. You take on more risk, but the profits can be juicy if you play your cards right. So, are you ready to ride the roller coaster? So there you have it, folks. The world of options trading, explained with the help of our trusty apple market analogy. We've taken a deep dive into the world of call and put options, unraveling the mysteries of buying and selling in the market. It's a lot to take in, we know, but let's take a moment to recap the core principles. Call options, remember, are contracts that give you the right, but not the obligation, to buy shares at a specified price within a set period. Picture yourself at the Apple market, holding a voucher that lets you buy Granny Smiths at a set price, no matter how high they might soar in the market. That's a call option in a nutshell. On the flip side, we have put options. These are contracts that give you the right, again not the obligation, to sell shares at a predetermined price within a set time frame. Imagine you've got a bushel of apples, but you're worried the price might drop. So you secure a contract that allows you to sell your apples at today's price, even if they're going for peanuts tomorrow. That's the power of a put option. Whether you're buying or selling, call or put, understanding these concepts is key to navigating the waves of the stock market. It's not just about picking the ripest apple or selling at the highest price. It's about understanding the market, knowing your options, and making informed decisions. So, as you dip your toes into the waters of trading, remember these key points. They'll serve as your compass, guiding you through the turbulent seas of the stock market. Remember, the stock market isn't all about chasing the juiciest apple. It's about making informed decisions and understanding your options. Until next time, happy trading. And if you've enjoyed this jaunt through the Apple market, don't forget to like, share, and subscribe for more trading tips and tricks. Stay savvy, traders. In our journey through the world of trading, we've explored the market, understood the power of options, and learned about making informed decisions. However, it's crucial to remember that this information is presented for educational purposes only. We're here to help you understand the complex world of trading. But we're not here to provide financial advice. Every investment decision you make should be based on your own research, your own understanding of the market, and most importantly, your own risk tolerance. Every market move is a gamble, and while understanding options can help you make informed decisions, it's never a guarantee of success. So before you dive into the stock market, take a step back, do your homework, understand your risk tolerance, and most importantly, never invest more than you're willing to lose. Remember, the world of trading can be as risky as it is rewarding. So, trade wisely, trade safely, and as always, happy trading. And if you found this video helpful, don't forget to like, share, and subscribe for more insights into the world of trading. Stay savvy, traders.